My guest today is Dave Savage. He is the founder and creator of a company called Mortgage Coach. More specifically, he's a mobile tech pioneer and a mortgage industry agent of change, a renowned speaker and keynote at mastermind events, sales rallies, and strategic industry events. He's committed to educating and preparing lenders and loan officers for the digital mortgage revolution. Today, he's interviewed more than 1,000 industry leaders, and the Mortgage Coach channel has been described as the most valuable YouTube channel for mortgage professionals. Dave, you ready to take us to the top?
Yeah, let's do it, man.
All right, very good. So YouTube's your main channel, huh? How many views will Upload get once you put it up?
It's a B2B. So, on average, probably 500 views. Our biggest views are like 10,000-ish, when I have big guests, but almost every video gets at least 500 views.
So you're using this to grow the software side of your business, which I believe is mortgagecoach.com. Is that right?
Yeah. Well, I would say when I create content, it's twofold. It's one, to add members. We're a SaaS technology company, so we always want to add members, but we want to get more adoption of our technology. So a lot of the interviews are with top producing loan officers that use our tech, and we're trying to get them to inspire other loan officers to use our tech.
So help me understand your model on Mortgage Coach. Is it a SaaS platform?
Yeah, it's a SaaS technology platform.
Okay. And on average, what are users paying per month to use it?
$90 a month per user. We've got over 10,000 users.
That's great. So 90,000 a month. And can I take 10,000 times 90 and that obviously gives us your revenue?
No, because only about 2,000 of the users are individual loan officers that pay us 90. And then the other 85% of our network are corporate deals. And let's just say there's a 20%-ish. Those are based off of the size of the relationship.
Okay, let's just assume the minimum. If I take 2,000, which you just said are paying $90 a month, that puts you at about 180 grand a month in SaaS revenue. Is that accurate?
That is accurate.
Okay, and then help me understand growth on that cohort. So a year ago, how much were you doing per month, would you say?
Our individual user network has been pretty flat. We don't put a lot of resources behind that. We're an enterprise first SaaS company, so we really look at those as like leads. And maybe that side of our business has grown 10-ish% year over year.
Well, help me
enterprise platform.
And yeah, you're more enterprise. Totally understand. Maybe let's focus there instead. So you said 8,000 of the 10,000 are enterprise deals?
Yeah.
Okay, and what does that mean?
What do you mean? What does that mean?
When an enterprise uses you, what does that mean? Are they using you?
That means the mortgage company would buy us and roll it out to their loan officers. So the loan officers, salespeople for the mortgage company would use our platform. The company would pay us, and then they'll make it available to their loan officers.
And is that still those 8,000 mortgage companies paying you on average $90 a month, or they pay you more?
No, it's less. It's less.
Why does the mortgage company pay more than the individual mortgage broker?
Well, they don't. They pay the individual loan officer. It's like one loan officer signing up. And the enterprise would pay less. They're buying 50, 100. Our biggest enterprise client has 1,000, licenses. So they get a volume discount.
Got it. So all in all, you have about 10,000 paid seats, whether it's the loan officer paying for one seat directly at $90 or a bulk deal with someone paying for 1,000 seats.
Correct.
Okay, fair enough. That makes a lot of sense. And then instead of trying to get the different models on those different cohorts, when you look at just a blended average per seat cost across your entire user base, what would that come out to? It's not 90, it's less than that.
Yeah. I'd say 60-ish.
60-ish. Okay, got it. So that would put you at 600 grand a month in revenue. Is that right?
Yeah.
Okay. And that growth rate year over year, are you kind of 10%, 20%, doubling year over year? Where would you put it at?
Last year we were a little over 10%. Year before we were 30%. Our goal is 30% year over year growth.
Okay, that's great. Now, have you bootstrapped the company or raised?
Yeah, I total bootstrap, founder raised.
I love
started
that.
It many years ago.
I love the fact that you've been able to get to that scale bootstrapped is actually, that's extremely impressive. So if you're growing 10% year over year, that means you're doing what, about $550,000 a month a year ago, $600,000 a month.
No, it's I would say coming out of the meltdown, 2008, we really, shrunk a lot. And then we have, we've had years where we've grown up to 30% and years where we've, grown 10%-ish.
What I'm trying to get to is the past 12 months. You said you grew 10%. Is that right?
Yeah, gotcha.
Is that right? 10%?
Yeah.
Okay. So if you're at 600 grand a month today, 10% growth would mean you came up from 550 grand a month about 12 months ago. That would be 10%.
Correct.
Okay. Just want to make sure there. What's driving most of the growth? New customer additions or driving more revenue inside of mortgage brokerages by getting them to add more seats?
A little bit of both. I mean, I would say last year it all came from growing existing accounts, adding members with existing clients that would either acquire another company and turn on more users. And then we add probably 20 new logos, 30 new logos a year.
Okay.
That's new lenders to the network.
Yep. And they individual lenders or brokerages that service a lot of lenders?
Lenders, individual mortgage bankers.
Okay, so you have 10,000 total right now, and you're adding 20 new.
Well, that's users. That's users. No, the 20 is like a brand, like
Got it.
The name of a company. There could be 50 loan officers. There could be, hundreds of loan officers.
Got it. How many folks are on your team building this?
Got about 30 employees.
Okay, 30 folks, and I assume break even because you're bootstrapped, right?
Well, we're profitable.
Okay, so profitable, and why are people signing up for this? So I assume they get pitched all the time on tools like this. What's your unique mousetrap? Why do they love you?
Well, it's conversion, lead conversion. I mean, I don't know if you're familiar with the book called The Challenger Sale, but we are a sales effectiveness platform. So we're not a CRM. We integrate with all the technology in the mortgage space, and they buy us to get improved conversion.
Mm-hmm.
We deliver a better conversation, and the actual thing that we do is help a loan officer deliver mortgage options in a way that's a competitive advantage. Most loan officers quote rates. Here's your monthly payment. Here's your closing costs. With Mortgage Coach, it's graphs and charts. It's an omni-channel platform. It's got video streamed into it. So it's a sales effectiveness technology platform.
Okay. And do you have a sense, effectiveness can be measured on how sticky it is, right? How addicted are your users, which can be measured by churn. So over the past 12 months, do you know what your churn rate has been?
Yeah, anybody that creates more than 10 total cost analysis never leaves. So any churn that we do have, it's from someone never using it, signing up, gym membership, never show up. But once someone uses the product, we never lose them. And we've got a 90+% retention rate.
Okay. So less than 10% of churn revenue annually.
Correct.
And expansion, does the expansion on that same cohort more than make up for the lost 10%?
Yeah, that's how we're growing.
Well, you can grow by adding new customers and have no expansion.
Fair enough. Right. But we're growing through a combination of new brands and growing existing clients.
Yeah. So just so I make sure, because I don't want to misrepresent you and the success you've had, the customer base that signed up exactly a year ago, you'll lose over, they were new, today, 12 months later, you'll lose 10% of their revenue. But that same cohort, you got other customers in that same cohort to upgrade their accounts by more than 10%. So your net revenue retention is above 100%. Is that right?
Yes.
Okay. What's going through your head? You're thinking?
Well, you said the 90, I just wasn't completely following you on that. I mean, our net retention numbers are less than 10%.
Well, that doesn't make any sense. If your net retention is less than 10%, it means you're churning almost your entire customer base every year.
Oh, well, no. Well, I'm saying we're losing 10%. We're maintaining 90% retention.
Yeah. So what I'm asking is when you're let's say 10 customers signed up a year ago paying you $100,000 per year, you lose 10% of that revenue. So now it's only 9.
Yeah, I'll lose one. Correct. I'll lose one of those.
Well, it's not about, it's not about Dave, the logo count. It's about the revenue the logo makes up. So if you have $100,000 that signed up in a cohort a year ago,
losing the revenue. By the way,
go ahead.
You're cutting out on me. Oh,
yeah,
no,
I know. Go ahead.
Cut out. I didn't.
What I was saying is it's not about the logos. It's about the revenue the logos make up. So if you have 100,000 in new contract value you signed up a year ago, right? You're saying 90,000 of that will renew. That's 90% retention. And my question is, do you upgrade those accounts when you renew by more than $10,000, the ones that stay? So you make up that churn hole.
Some do, some don't. It just depends. We could lose revenue because the lender lost loan officers.
Well, of course. I mean, it doesn't matter why you lost it. It's just trying to measure, trying to understand your metrics.
Right.
So, okay, got it. So we'll just put no expansion revenue for now, 90% net revenue retention. That means you're retaining, again, about 90% annually. So that makes sense there. That's good. How are you've done an incredible job getting new customers. I mean, 10,000 is not easy to grow to. So what's the secret there? What mousetrap have you used?
I mean, mainly sales to sales, enterprise salespeople. I do think we've done a very effective job of building our brand in the mortgage space, and the combination of our YouTube channel and our Facebook group, Mortgage Coach Productivity Mastermind, has definitely helped us, build the brand, create leads, create growth. But, all the new, call it new lenders that we add, they come through a, enterprise sales force.
Mm-hmm. How many? So you said 30 people on your team right now. How many of them are sales?
Well, I've got 4 in customer success managers managing and growing existing relationships, and 3 going out and bringing in new lenders.
Okay, 4 success reps. And then how do you generate the leads for the 3 that are going out, like account executives closing new deals?
Yeah, everything from them, just making calls, going to events. We use HubSpot as our CRM and marketing automation platform. Combination of, social, email, and phone calls and text.
And how aggressive are you being, Dave, kind of on getting new customers in the door, right? So if a new seat is, again, $10 a month, or sorry, what did you say? What did you tell me? $60. No, weighted average 60. Yeah, $60. How aggressive will you be in terms of signing that $60 a month customer up?
We don't do tremendous amount of discounting. We do, and we also price on a cost per transaction, so they have closed loans. We don't discount very much.
Sorry, when I look at fully weighted CAC, that would include your 3 salespeople, right? And it would include any direct paid, it would include any affiliate spend, and any kickbacks, partnerships. So, like,
we're not doing any affiliate or partnership investment.
You have 3 full-time.
It's an enterprise sales. Yeah.
Yeah. Again, even with enterprise sales, there's CAC associated with that. That's what I'm asking you. So if someone signs up for $60 a month, right? Or what is that? $720 a year. Will you spend a full $720 to get them signed up at the beginning?
What do you mean? You mean in terms of what's our cost per sale?
Exactly. Including commissions and headcount expenses.
Yeah, I guess we probably do. Yeah.
You don't track that number?
I track it, but I don't know that metric off the top of my head, and I probably wouldn't share it. But I don't know the metric off the top of my head.
Okay. So what's as you're growing this company, right? 30 people today, you're doing speaking on the side, you have a Facebook group, YouTube channel. I mean, what's your next big, there's 6 months left in 2019. What's your next big revenue target? What do you want to hit by the end of 2019?
We want to hit 30% growth this year. So, we want to add, another $1.5 million to $2 million in revenue, $2 million in revenue this year. Okay, so so I would say my main focus is closing new brands and growing existing clients.
Yeah. So if you do $2 million in total revenue this year, that'll get you really excited.
Yeah, definitely. Extra incremental revenue.
Well, no, sorry. Total revenue this year. If you hit, what do you want to hit in total revenue this year? You think?
8 million.
Yeah. 2 incremental. That's where your growth is coming from. And when did you launch the company? What year?
Well, it's a 20-year-old business, but I mean, coming into the meltdown in 2008, it became a much smaller business. So I would say the company, 2.0 Mortgage Coach really started in 2008.
Okay, but started originally in 2000.
It will. I originally founded the company in 1998 as just kind of a side project. I owned a mortgage company, and it was a hobby company that I had, and I founded it as a passion project.
Yeah, that's great. Do you have any plans to raise capital?
I do think, we get a lot of folks coming after us every year, and I think it's likely that we will raise some capital this year.
If you do raise, what's the right amount to raise? What would your target be?
Yeah, I don't know. We've been talking about that, but I would say it wouldn't make sense to do a deal for anything less than 5 million.
Yeah.
I think that would be what we're thinking about right now.
And then you have protected the hell out of this thing, and you should. I mean, this is an incredible bootstrap story, which I love. The whole idea of kind of slow growth. You've done the chugging, so you don't want to raise that capital and then take a huge hit on the equity side. So, I mean, generally speaking, what valuation would make you happy in terms of what you raise at?
I'm not going to comment on my valuation right now.
It's not what your valuation is. It's what you'd want to be at when you do decide to go raise.
Yeah, I'd rather not, comment on what I think valuation is right now.
Again, I don't want to know your valuation right now, but someone who's bootstrapped their company, you have a target in terms of the equity you may or may not want to give up when you do raise. Would you try and stay below a certain percentage when you do decide to go raise?
Well, yeah, but I don't really have a target on that. I'm more looking at what is the valuation of the business, and don't want to comment on that.
Okay. You understand I'm not asking what you're at right now. I'm trying to get a sense of how you think about it in the future. So if someone came and offered you $5 million today for 50% of the company, you obviously would not do that. Exactly. So again, I'm trying to get in your head and understand how you're thinking about valuation, not reveal numbers of your actual company right now, but how do you think about valuation of the company?
Like, what do you mean? How do I think about it?
Do you look at it in terms of it's based off your customer base, or no, the tech is your biggest advantage, or no, it's an ARR multiple? There's all kinds of ways to value a SaaS company.
Yeah, I mean, it would be probably a multiple on sales. That's how the investors that I talk to would look to invest a multiple of our sales.
Okay, very good. All right,
go ahead.
No, go ahead. I don't mean to cut you off.
Oh, no, I was just going to say, I think on the low end, people are, 3 times, and on the high end, 8 times, Those are the numbers that we typically hear in the marketplace.
Yeah. So if you raise at the end of the year and you hit your 8 million mark, 3x would be 24 pre and about 30 post, right? So you can do the math there in terms of you're selling, what is that? 5%. Well, no, I mean, you're getting up there where you're still selling, 10, 15% of the company bootstrapped. Let me ask you a question. Do you really want to take the equity hit? Would you ever consider using debt to drive the growth of the business so you keep full control?
Yeah, we're considering that.
Yeah. Interesting. Very good. All right, let's wrap up with the famous 5. Number 1, what's your favorite business book?
Favorite business book? Simon Sinek's book on, is it The Power of Who, or?
Well, he has a bunch. So
who or what?
Start with why. Leaders eat last.
Starts with why.
Okay.
Simon Sinek.
Number 2, is there a CEO you're following or studying right now?
I always follow Facebook pretty closely. So Mark Zuckerberg. Yeah, that's the one.
Number 3, what's your favorite online tool for building your company besides your own?
For building my company? Probably, I love what we do on YouTube, and I think it's an incredible tool of growth and education in our industry.
Mm-hmm. Okay, good. So YouTube, that's your answer?
Yeah, but in terms of tools I use and I love Slack. Slack has really helped us, culturally and communication internally. So if you're looking for a internal business tool, I'll give Slack the nod. And if you're looking for outside tech that helps us, drive our mission and educate the marketplace, YouTube.
Number 4, how many hours of sleep you get every night?
7.
Okay.
And I'm obsessive. I use sleep, track it. I average, right now I'm a little under, but 7 hours of sleep a day is what I need.
And what's your situation? Married, single, kiddos?
Married, 2 kids.
And how old are you?
54.
Last question. What do you wish your 20-year-old self knew?
What I wish my 21-year-old self knew. Whew. Gosh, I don't know what I would do different, man. I've had a pretty fun life, man.
It's not what you'd be different. Maybe think about it in terms of what's a lesson you tell your kids right now, assuming they're kind of 18, 19, 20.
Never sell real estate. Buy it, never sell it. There's some houses I wish I wouldn't have sold.
Guys, there you have it. Never sell real estate. Coming from the real estate guy. No, just kidding. All right, he's built a great company. This is the whole. Yeah, there we go. This is the whole story of what we call slow growth. Dave launched the company back almost 20 years ago, almost at a total reset in 2008. Bootstrapped his way, growing 10%, 20% year over year to $600,000 per month right now, and revenue over 10,000. Again, users using the platform across many hundreds of lenders, paying on average $60 a seat. That's up from $500,000, $550,000 about a year ago. Again, all bootstrapped growth, which is just nice to hear. Team of 30 as they look to scale, only churning about 10% of their user base each year. They are profitable. Maybe raise $5 million later this year. We will see. Dave, thank you for taking us to the top.
Take care, man.